Friends, I have been receiving emails and comments, and the aspirants have requested that I should start from the topics in the syllabus instead of picking up random topics. So today we will start with the first topic from the paper one, that is economic and social issue, and topic is measurement of growth, national income, and per capita income. So now onwards we will be picking up one topic and we will be discussing about the topic so that we can see that how much syllabus we have completed. So in this topic we will discuss about frequently used terms, since it is an objective type of exam, so you should be well versed with the frequently used terms pertaining to national income and per capita income, then national income definition and methods of calculating national income, and how GDP, NDP, GNP, NNPs are calculated, and what is per capita income and how it is calculated, and transition of GDP. And then we'll go to limitation in calculation of national income in India. So let's see the frequently used terms. First is final good. An item that is meant for final use and will not pass through any more stage of production or transformation is called a final good. For example, in a rubber factory, the rubber is the intermediary good. When the rubber is turned into a chappal, that chappal will be the final good. Consumption goods like food and clothing, and services like recreation that are consumed when purchased by their ultimate consumer are called consumption goods or consumer goods. And then capital goods, goods that are of durable characters which are used in the production process. These are tools, plants, machinery, etc. These helps in the production of goods. So they are called capital goods. Then we have intermediate goods. These are neither the final good nor the capital good. So when they are processed, they turn into the final goods, like the wheat in the bread making unit. So wheat is turned into the bread, which is the final good, and wheat is the intermediary goods. Then these are the two important concepts that you should know: flow and stock. A flow is a quantity which is measured with reference to period of time. Thus, flow are defined with reference to a specific period. Length of time, that is hour, days, week, months or year. National income is a flow. So flow is calculated for a particular, say in a 1 month, how much is the income we are receiving. So our income, monthly income is the flow. Whereas the stock is the quantity which is measured at a particular point of time, that is at 4 p.m. 1st, and in that way national wealth is the stock. So similarly, if we talk about our bank balance, if we talk about our wealth which we have created through our salaries and all the other incomes, that is called the stock. Whereas the monthly salary which we are receiving, that will be the flow. So national income is a flow, whereas national wealth is a stock. These 2 points you have to remember. Then factor cost. This is the input cost the producer has to incur in the process of producing something. This is also known as factory price. So whatever the labor charges and the electricity charges and other charges, rented, etc., which the producer is paying, that are called the factor cost. So when all these costs are included, then the final cost of the product is derived. So this cost is called the factor cost, and this is also known as the factory price. So above factory price, there will be certain charges which will be added. And market cost, this is derived after adding indirect taxes to the factor cost of the product. This is cost at which the goods reach to the market. So when we add indirect taxes to the factor cost, the cost will be called as market cost, at which we buy from the market. Nominal income, the wage one gets in hand per day or month. So if you are getting 10,000 per month, so that will be your nominal income. When the nominal income, where you reduce inflation adjustment from the nominal income, your income will be the real income. So suppose you have invested 10,000 in a bank and monthly you are receiving 1,000 or say 10% interest on that income. So the 10% is your nominal income on that investment. After the 10%, if there is suppose 5% inflation in the market, so 10% minus 5% inflation is adjusted. So your total real income from the FD is 5%. And disposable income, this is the income when one can use. This is calculated after deducting indirect taxes from the real income. So the 5% which you are receiving, so after 5% when you receive, you will have to pay certain taxes, direct taxes like income taxes you have to pay. So when you reduce the income tax from the real income, then you will have the disposable income that you can use wherever you want to use. Now we will go to the national income. So first see what is national income. National income measures the monetary value of the flow of output of goods and services produced in an economy over a period of time, generally 1 year. So this is the, since we talked, this is a flow concept, so we have to take a period of time. So generally we take 1 year, and you will be seeing that it is also called calculated on quarterly basis. So it also takes, the period is also taken as quarterly. So now, which are the methods of calculating the national income? These are generally three methods: the value added method, the income distribution method, the final expenditure method. So we'll see each of them one by one. So first, let's see the value added method. The value addition, the word you have to think about the words, then it will be very easy to understand. So value addition, it means you are adding certain value to the goods. Suppose for example, if we talk about the tailor, what he is doing, he is adding value to the cloth and making it a product, say shirt or trousers. So that is the final word. So he is adding certain value. So this is also called output method or production method. In this method, the value added by each enterprise in the production of goods and services is measured. Every individual enterprise adds certain value to the products which it purchases from some other firm as intermediary goods. When value added by each and every individual firm is summed up, we get the value of national income. We'll see it with an example, frequently used examples. I've also used. Suppose in an economy there is only one farmer and one baker. So the farmer produced wheat of rupees 100, out of which he consumed wheat worth rupees 150 and sells the remaining to the baker. Now the baker makes the bread and sells the bread for rupees 200. So in that way total production will be 200 by the baker and 100 by the farmer, so 300. But since the baker bought wheat worth rupees 50 from the farmer, so thus the total value added by the baker is 200 minus 50 is equal to 150 rupees. Now to calculate the value added GDP, we calculate value added by the farmer plus value added by baker. So 100 value which was added by the farmer plus 150 which was added by baker. So total value of the GDP at value added method will be 250 rupees. Similarly, we calculate value added by all the factors and then we calculate the value added method. Then the next method is the income distribution method. Here the GDP is the sum of the incomes earned through the production of goods and services. So GDP is equal to income of people from jobs and self-employment plus profits from the business plus rent income from the ownership of the land. So when we add these three incomes, we get the GDP at income distribution methods. However, we do not include transfer payments like pension received from government, help received from family members, and unemployment allowances, etc. Because here you are not adding any value. Similarly, private transfer of money from one individual to the another is also not included. And income not registered with revenue or custom department. People do not declare certain amount as income to the revenue department. This is known as shadow income or black shadow economy or black economy. Then next method is the final expenditure method. The GDP under the expenditure approach is calculated by adding up all the expenditure made on final goods and services produced within the geographical boundaries of a region. These include consumption expenditure by household, investment expenditure by business, and government expenditure on purchase of goods and services, and net expenditure by foreigners, that is net exports, which in turn equals total export minus total imports. So these expenditures, when we add, we get the final GDP. So the formula of GDP calculation under the expenditure method will be GDP is equal to C plus I plus G and X minus M, where C is personal consumption of expenditure. So this includes all the expenditures incurred by the persons, like when you are buying certain things like consumer goods, when you are going to get your haircut, when you are spending for your health expenditure, etc., which are calculated under C. Then comes I. I stands for gross private investment. And this includes the private investments by the businesses, like establishing new plant, buying new machinery, etc. And the government expenditure and gross investments include the expenditures of the government on the salaries of the government officers, expenditure of government on the capital, building the capital assets, and various other expenditures of the government. And then we net the export minus import. So the total net is calculated. When we add all these figures, we calculate the GDP at the net expenditure method. Then the gross domestic product. GDP is the value of all final goods and services produced within the boundary of a nation during 1 year. So GDP is the value of goods and services produced within the boundary of a nation, within the boundary of the nation. So we do not include the income from the overseas. In India, we calculate it from April 01 to March 31st. Generally, it is calculated the growth rate of GDP. We talk about that GDP is growing at 7.5%. This means the GDP has grown 7.5% from the previous year GDP. So suppose previous year GDP was 100 rupees. So this year's GDP is 107.5 rupees. And net domestic product, when the depreciation is reduced from the GDP, the net domestic product is calculated. So net domestic product formula will be NDP is equal to GDP minus depreciation. So this term is not frequently used. And then comes gross national product, which is very useful. Here we take the national product. In GDP, we were taking the domestic product within the boundary. So in GNP, what we do, we calculate GNP of a country, we add income from abroad in the GDP. So income from abroad includes trade balance. When we are selling goods, when we are buying from abroad, there will be certain balance. So net of that will be included here. And interest on external loans, we take loans from foreign institutions, from foreigners. So whatever the interest we are paying and whatever the interest we are receiving, the net of that will be calculated. And finally, private remittances, those Indians who are working in foreign firms or who are working in foreign land, they will be getting certain salary and they will be sending that salary to India. So, and similarly, those foreigners who are working here in India, they will also be sending their salary to the foreign nations. So when we take the net of these private remittances, So when all the three are included, that the net income will be called as income from abroad. So when this net income from abroad is added to the GDP, we derive the figure of gross national product. From the gross national product, when we reduce the depreciation, we get the net national product. So net national product can also be GDP plus income from abroad, that will be GNP, and minus depreciation will be NNP. So this is the purest form of national income and written as NI. GDP, GNP, NDP, GDP, extract at all are called national income. However, this NNP is the purest form of national income. And national income at factor cost is equal to national income at market cost minus indirect taxes plus subsidies. We talked about that factor cost. When we add the indirect taxes into the factor cost, it becomes market cost. We seen this during frequently used terms. And plus subsidies, when you add, you will get the net national income at factor cost. Now comes the per capita income. So when the NNP or net income is divided by the total population of the nation, we get the per capita income of the net nation. So NNP divided by the total population of the nation is equal to per capita income of the nation. We should note that the depreciation makes a big difference in PCI. Countries having higher depreciation rates will have lower PCI. So if those countries having the high depreciation will have the lower per capita income, we see the previous example here. If you'll see, NNP is calculated GDP plus income from abroad minus depreciation. So if the depreciation figure is higher, your NNP will be lower. So the total per capita income will be lower. So if a country wants to increase its net national income, it can reduce the depreciation rates, and that will increase the NNP, and that will result into increase in per capita income. Now transition of share of GDP. So when an economy is underdeveloped economy, the domination will be the agriculture sector, which will be followed by, then gradually the dependence on agriculture sector will reduce, and the dependence on industrial sector will increase. So industries will be developed and service sector will be very less. And then in developing sector, the share of industry will increase. So people will start focusing on agriculture, start focusing on industries, and the people who were henceforth working in agriculture, now they will start moving toward industries, and the industry of that country will increase. And thereafter, once the industries are at the good stage, then the economy will move toward developed economy. Here the share of service sector is increased, which will be the highest, and then the share of industrial will be the second highest, and the agriculture sector will be very less in the total share of GDP. However, if we see the Indian scenario, then you will find that at the time of independence, the share of agriculture was highest in the Indian GDP, which frequently turned into service sector. Today, the service sector share is highest in GDP. However, the industries did not develop in the Indian market. Now next we comes to the limitation of national income estimation in India. First is the output of the non-monetized sector. Some part of the commodity does not reach to the market, consumed by self or used in barter systems, so they do not get into the market, and the value of these goods and services are not included into the GDP, and this results into the lower amount of net national income. And non-availability of data about the income of small producer or household enterprises, and the unreported illegal income. So income from various sources which people are not reporting to their income, and while filing the income tax returns, and income received through corruption mode. is also not included in the national income. So these are the some of the challenges which are faced in Indian national income estimation in India. So this here we complete the first topic. So if you have liked my video, please like, comment and share. So depending on the views, I'll make another videos on the topic, and we will be going through the topic by topic in the syllabus. Thanks for watching. If you are not subscribed to my channel, please subscribe to my channel so that you will be getting regular videos on the preparation of grade BDRs and various other topics. Thank you so much.